So imagine a company whose stock has like essentially doubled in just a single year.
Yeah, which is wild on its own.
Right. And they've partnered with these absolute titans in the AI space. They just posted their 20th consecutive quarter of beating Wall Street's expectations.
20, it's crazy.
20. And they're sitting on a fresh $1 billion war chest. So, you would probably assume the executives running this operation are like mortgaging their houses just to buy up more of their own stock.
I mean, that would be the logical conclusion, right?
Exactly. But instead, they are actually selling.
It is honestly the ultimate puzzle for anyone paying attention to market right now.
Yeah.
Because when you see a disconnect that massive between, like, the flashy headlines and the actual behavior of the people inside the building, you know there is a much deeper story waiting to be unpacked.
Yeah, and that is exactly what we're doing today. Welcome to today's Deep Dive. We are looking at a marketing technology company that has just been entirely dominating the financial news cycle lately, ZETA Global.
ZETA Global, yeah.
And we have pulled together a stack of sources for you today. We've got a comprehensive equity research report, recent earnings data, a technical stock analysis, and some market sentiment updates.
A lot of material to go through.
A ton of material. But our mission today is really to figure out what is actually powering this company's massive growth. Like, is this a sustainable engine you can trust, or is it, heavily manufactured?
Well, to even begin to understand why Wall Street analysts are just buzzing about this right now, we kind of have to look at the sheer scale of the numbers ZETA just reported.
Right. Let's start with the numbers.
Yeah. So for the first half of 2026, they brought in nearly $840 million in revenue.
Wow.
Yeah, that is an increase of almost 47% compared to the same time last year.
I mean, a 47% jump for a company that's already operating at that kind of scale it's massive. And if we isolate just their second quarter, they pulled in roughly $440 million. But, the revenue isn't actually the detail that caught my attention the most in the sources. The research highlights that they just shifted to GAAP profitability. They posted an $8 million net income for the quarter.
And we should pause there because that is a crucial threshold in the tech sector.
Oh, absolutely.
Because, look, most tech companies love to highlight their adjusted earnings.
Yeah, the adjusted numbers always look better.
Always. Because it's essentially this heavily massaged metric where they strip out all these massive operating expenses. Usually it's like stock-based compensation for their employees, and they do that just to make their balance sheet look cleaner.
Yeah.
But GAAP stands for Generally Accepted Accounting Principles. It is the strictest, most rigid definition of profit. So hitting GAAP profitability means ZETA is actually generating real, unmanipulated cash flow.
Right, but hold on, though. Because the research also points out this was their 20th consecutive beat and raise quarter.
Yeah.
Meaning they beat expectations and then raised their future guidance 20 times in a row.
That's 5 straight years.
5 straight years. Doesn't that sound almost, perfectly engineered? Like, at a certain point, are they just playing games with Wall Street's expectations?
I mean, it is a totally fair question. The whole beat and raise cycle is a very well-known corporate strategy.
Yeah.
Management intentionally sets their public forecasts, like slightly lower than what their internal data shows they can actually achieve.
Underpromise and overdeliver.
Exactly. They underpromise so they can publicly overdeliver.
Yeah.
But doing it for 20 straight quarters through wildly different economic environments over the last 5 years, that requires an incredible level of execution discipline.
I guess that's true.
You can't just manipulate expectations for 5 years if the underlying business isn't actually growing.
Okay, so let's talk about what that underlying business actually is then. Because you really cannot analyze a tech stock in 2026 without, running into artificial intelligence.
Oh, impossible. AI is everywhere.
Right. And ZETA is aggressively pushing their AI platform, which they call Athena. The sources mention they have integrated partnerships with OpenAI and Palantir. But, what does that actually mean in practice? How is a marketing company using Palantir?
So think about what a modern marketing campaign actually requires today. You have just mountains of chaotic consumer data.
Yeah, browsing habits, purchase histories, all of that.
Right. Demographic shifts, clicks, everything. And Palantir is arguably the best in the world at data ingestion and pattern recognition.
Okay.
So ZETA uses Palantir's underlying architecture to sift through all that messy data and find the exact specific customer profile who is ready to buy a specific product today.
Okay, so Palantir acts as like the targeting system.
Exactly.
So where does OpenAI fit into the equation?
Right. So once Palantir's analytics identify that target audience, OpenAI's language models step in. They can instantly generate hyper-personalized marketing copy,
Hmm.
tailored specifically to that exact demographic. Yeah. And then Zeta's Athena platform serves as the central hub that actually executes and deploys the campaign across the internet. It's basically an end-to-end automated marketing engine.
See, that helps make sense of another phrase I saw in the report, the One ZETA sales initiative.
Ah, yes.
It sounded like totally corporate jargon at first, but if I'm understanding the technology right, they aren't like selling these tools piece by piece anymore.
Precisely. Historically, marketing tech companies sold a fragmented suite of tools.
Hmm.
You bought the email sender, then you bought the analytics dashboard, then maybe the customer database.
Right.
But the One ZETA initiative is a unified sales motion. They're going to massive enterprise clients and essentially saying, hey, do not buy 5 different software packages from 5 different vendors. Buy our one cohesive ecosystem that does the targeting, the creative generation, and the deployment.
It's a one-stop shop.
Exactly. And it acts as a massive competitive catalyst because it just simplifies the client's life.
Well, it is clearly working on the analysts. I mean, Citigroup recently bumped its price target on the stock up to $35,
Yeah.
and several other major firms raised their targets immediately post-earnings, too. The sentiment is so strong right now that commentary on Seeking Alpha literally compared buying Zeta today to buying Palantir back in 2020.
Which is,
I mean, that is a legendary growth run they are comparing it to.
it is. And that comparison is exactly why we need to be really cautious here.
How so?
Because when the market starts comparing a marketing tech company to one of the most successful defense and data software runs of the entire decade, it means investors are pricing in absolute perfection.
Oh, right.
Yeah, any slight stumble,
Yeah.
any missed expectation, it just gets punished severely when expectations are that high.
Which brings us to the actual stock price. Because if expectations are sky high, how is the stock behaving? The trading data shows it recently closed just under $30.
Right.
And to put that into perspective for you, it is up well over 100% from its 52-week low of roughly $14. It has effectively doubled.
The momentum is staggering. And the technical analysis in the research confirms just how fast it's moving. Like the stock is currently trading well above its 20-day, 50-day, and 200-day simple moving averages.
Okay, so for anyone who doesn't spend their day staring at stock charts, why do those specific time frames matter?
Sure, so a moving average just smooths out the daily volatility of a stock to show you the true trend, right?
Yep.
The 20-day average shows short-term momentum, while the 200-day shows the long-term trend.
Okay.
So when a stock's current price is significantly higher than its 200-day average, which Zeta is, it means the buying velocity has been virtually vertical.
But there has to be a physical limit to that kind of velocity, right? I mean, technical analysts use a metric called the Relative Strength Index, or RSI.
Yes.
And the notes highlight that Zeta's RSI is hovering near 78. What does that number actually signal?
The RSI is essentially a momentum oscillator. It measures the speed and magnitude of recent price changes, and it operates on a scale from 0 to 100.
No, okay, so 78 is pretty high.
Very high. The conventional rule of thumb across the market is that once a stock crosses the 70 threshold, it is considered technically overbought.
Meaning what exactly? Like the buyers are literally running out of cash?
Essentially, yes. It indicates that the buying pressure has been so intense and the price has risen so rapidly that a natural exhaustion point is approaching.
Got it.
A pullback or a correction becomes highly probable because the late buyers start to dry up and the early buyers start looking to take their profits. At near 78, Zeta's stock engine is flashing red.
It is redlining.
Exactly.
But just as the dashboard is flashing that warning light, the company managed to secure a massive financial refuel. In July 2026, they closed a $1 billion credit facility.
And this completely changes the dynamic of the company's near-term future.
Yeah.
A credit facility is essentially a giant pre-approved loan from a syndicate of banks. They used a portion of it to refinance about $550 million in existing debt.
Why do that now, though? Just to get better terms?
Exactly. It lowers their interest spreads, meaning they significantly reduce the cost of servicing their debt. It just frees up cash flow.
Right.
But the really interesting part is the remainder of that $1 billion. It is specifically earmarked for mergers, acquisitions, and share repurchases.
So it is just this massive war chest sitting in the bank, ready to be deployed.
Yep.
And if management truly believed this $1 billion war chest and their new AI tech was going to double the stock again, You would expect them to be buying shares hand over fist,
You really would.
but they aren't. Let's look at that insider activity I mentioned at the very beginning of the deep dive.
It is one of the most compelling breadcrumbs in the research, honestly, because there have been zero open market purchases by executives recently. Not a single insider is buying shares with their own money.
Wow.
And in fact, there was a recent sale of 7,500 shares.
Look, I know 7,500 shares is like a drop in the bucket for a billion-dollar company. It is not an executive dumping their entire portfolio.
Right, it's small.
But the zero purchases is what gets me. If people who have access to the actual daily sales data think this stock is heading straight to $50, they would be buying.
Look, insider selling can happen for a dozen reasons. Paying taxes, buying a house, diversifying a portfolio.
Sure.
But insider buying only happens for one reason. They think the stock is going up. The absence of buying suggests that management feels the current price, near $30, has fully priced in all of their recent successes. They know the stock is overbought.
Which means we need to look under the hood and figure out what the insiders see that the headline readers are missing, because the research lays out a very clear bear case against the stock's current valuation.
It does.
Let's dig into that 44% revenue growth number they just touted.
This is where the distinction between headline growth and organic growth becomes so critical. The 44% is accurate. It is the total amount of new money that came in the door.
Okay.
But when analysts evaluate a company's long-term health, they look at organic growth.
Right. And the research points out that if you exclude revenue from political candidates and the revenue they essentially bought by acquiring a company called Marigold, ZETA's organic growth guidance is actually only 22 to 23%.
Yes, organic growth measures the true underlying momentum of the core business that existed a year ago. It strips out all those external factors.
I look at it like this. Imagine a guy bragging that he cut his marathon time in half.
Okay.
You think, wow, he has been training relentlessly. But then you find out he just bought a motorized scooter halfway through the race.
Right.
Yes, he crossed the finish line faster, but his actual running ability hasn't improved at all. ZETA bought a company, Marigold, and just absorbed their cash register. It technically boosts the revenue, but it doesn't mean ZETA's core AI platform is selling twice as fast.
That is a very accurate way to visualize it. Acquisitions buy you revenue, but they do not necessarily reflect the health of your primary product. And then, of course, there's the political revenue.
Yeah, this is the part that really made me pause. How big of a check are these political campaigns writing? Because the research implies it is heavily inflating their current numbers.
Well, during a major election cycle, political action committees and campaigns pour hundreds of millions of dollars into highly targeted data advertising.
Right.
And ZETA, with its AI targeting capabilities, is perfectly positioned to capture that spending.
But the election happens in November.
Exactly.
After that, the political spending drops to zero. That pipeline shuts off completely.
Which is exactly why political revenue is classified as cyclical and non-recurring. It is a fantastic short-term cash injection, obviously.
Sure.
But it is a structural risk if investors mistakenly believe that pace of spending will continue into 2027. If you back out the political sugar high and the acquired revenue, the core business engine is only growing at about 22%, which is exactly half the speed of the headline number.
Yeah. Wow. And the risks don't stop there. The research highlights a major dependency problem, too. It mentions ZETA is vulnerable to walled garden platforms and changes in data privacy regulations.
Yeah.
What exactly is a walled garden in this context?
So a walled garden refers to massive tech ecosystems that control access to their users. Primarily, we're talking about Apple and Google. They control the operating systems, the app stores, and most importantly, the flow of data.
So how does that threaten ZETA? Don't they have their own database for the Athena platform?
They do have their own proprietary data, which definitely helps.
Right.
But marketing tech companies still rely heavily on tracking user behavior across the internet, mostly to prove to their clients that an ad actually resulted in a sale.
Right.
They rely on APIs, application programming interfaces, to communicate with Apple and Google's systems.
Like when Apple introduced the Ask Not to Track prompt on iPhones a few years ago.
Precisely. That single interface change effectively blinded dozens of marketing companies overnight. It just cut off the raw data they needed to target ads.
Yeah.
So if Apple decides to further restrict how third parties can track conversions, or if new government privacy regulations limit data collection, ZETA's core targeting engine could be severely handicapped. I mean, They're building a brilliant targeting system, but they are building it on land owned by Apple and Google.
Okay, so we have organic growth running at half the speed of the headlines, temporary political cash inflating the current quarter, and structural risks from big tech.
It's a lot.
Let's look at one final piece of the bear case, because this one impacts you directly if you own the stock. Dilution risk.
Ugh. Dilution. It is the silent wealth destroyer in the tech sector.
Really is.
When a company issues new shares of stock, the total number of slices in the company pie increases. So if you own a slice and suddenly the company creates 1 million new slices, your slice represents a much smaller percentage of the total value.
And the research notes that year to date, their dilution has been practically non-existent, just 0.1%.
Yep.
But their own target for the end of 2026 is 3 to 4%.
That is a massive discrepancy.
Right. If they are at 0.1% now and plan to hit 4% by the end of the year, that means a flood of new shares is about to hit the open market in the second half of 2026.
And you really have to ask why they are projecting that sudden increase. Often, companies issue stock to compensate executives, reward employees, or, use as currency to fund new acquisitions.
Okay.
The problem is just the basic law of supply and demand. If a massive new supply of shares hits the market, and the buying demand doesn't aggressively increase to absorb it, the stock price will face severe downward pressure.
Especially considering the stock is already in overbought territory, according to the RSI. Like, the buyers are already exhausted, and now you're going to dump millions of new shares on them. That seems like a recipe for a sharp correction.
It is the defining tension of ZETA's current valuation. You are looking at a company that is fundamentally sound in many ways, but the stock mechanics surrounding it are incredibly precarious.
Let's summarize exactly what that tension looks like, because we have uncovered two very different realities today. On the positive side, you have a company that has crossed the hardest threshold in tech, GAAP profitability.
Huge milestone.
They are generating real cash. They have legitimate AI integration with industry leaders like Palantir, a unified enterprise sales strategy, and a newly secured $1 billion war chest.
Right, and that is the narrative driving the stock up over 100% this year.
Yeah.
But the contrasting reality is what the underlying metrics reveal. The stock's momentum is technically redlining. The executives running the company aren't buying a single share at these prices.
Zero.
And most crucially, that jaw-dropping 44% revenue growth is masking a core organic growth rate that is significantly slower, heavily propped up by temporary election spending and bought revenue.
It really hammers home the core mission of why we do these deep dives for you. You can never just take the massive, bold font numbers at face value. You always have to dig for the organic growth rate.
Absolutely. Organic growth is the true pulse of any business. It strips away the noise, the cyclical events, and the accounting maneuvers to show you whether the core product is actually gaining market share.
Which leaves us with a final, somewhat provocative puzzle to think about. Consider the timeline and the assets we just laid out. We know ZETA's core organic growth is slowing down to the low 20% range.
Yep.
We know they're expecting a sudden 3 to 4% dilution in their stock in the coming months. We know their stock price is currently sitting near a 52-week high, making it highly valuable currency.
Very valuable.
And we know they just locked in a $1 billion credit facility earmarked for mergers and acquisitions.
When you lay all those variables out side by side, a very clear strategic option emerges for management.
Exactly. The question you have to ask yourself is this. Will ZETA use their currently inflated stock price and that $1 billion in cash to aggressively buy up another company before the year ends? Not because they necessarily need the technology, but simply to buy more revenue, mask the slowing organic growth, and keep the illusion of 40% headline growth alive for another quarter.
It is the absolute most critical metric investors need to watch for in their upcoming Q3 earnings report. Will they use their war chest to buy their way into their 21st consecutive beaten race?
That is the mystery we leave you to ponder today. The market is incredibly good at telling you what is happening right now, but it takes looking under the hood to see what is coming next. Thank you for joining us on this deep dive. Keep questioning the headlines, keep looking for the organic momentum, and we will catch you next time as we continue to separate the hype from reality.